Ladies and gentlemen, welcome to the channel. In this video, we are breaking down SoFi, what is going on with the stock, what the analysts are saying, what management is doing, and most importantly, is now actually a good time to buy. As always, this is not to be considered financial advice. If you are taking any risk in the market, you should absolutely do your own research on all stocks and ideas presented here. We are just two people having a conversation about a company we find interesting. Nothing more. If this is your first time here, don't forget to hit like and consider subscribing if you find this information useful, because it really does help the channel and allows us to keep bringing you this kind of detailed breakdown. With that, let us get into it. Let's start with the big picture, because context matters here. SoFi has had a rough stretch. The stock has come down significantly from its highs. We've seen 10 analyst price target cuts across two waves in just 2 weeks. Goldman Sachs, Morgan Stanley, Citigroup, Mizuho, you name it. All cutting in the same direction. And if you've been in the comments section or scrolling through social media, you've probably seen a lot of voices saying the story is broken. But here is what's interesting. When you actually go through every single one of those analyst reports, and I mean every one, they all have something critical in common. Not one of them is modeling a specific acquisition that SoFi made after Q1 earnings. Every single model assigns that acquisition a value of exactly 0. Not because it's worthless, because they had no idea it happened. We'll get to that in detail in a moment. But first, let's understand exactly what happened with earnings and why the market reacted the way it did. Q1 earnings came in and the results were, honestly, fine. EPS was up 100% year over year. Revenue continued to grow. The member base hit 14.7 million and kept growing. Management maintained their full-year guidance of 60 cents in EPS. So why did the stock fall and why did analysts pile on with cuts? 2 reasons, and I want to be fair here because both of them are real. The first concern is Galileo. Galileo is SoFi's B2B fintech services segment, the technology platform they power for other financial companies. And Galileo revenue dropped 27% year over year in Q1. Now that is a real number. I am not going to brush past it. The argument that analysts are making is that if the tech side of the business is shrinking, then SoFi is just a bank, not a fintech, and it should trade at a bank multiple, not a tech multiple. And that multiple compression is a big deal when it comes to price targets. Here is the context, though. That 27% drop was largely driven by the loss of one major anchor client, Chime, and that client transition was a known event. It was expected to complete by the end of 2025. When you lose one client that big in a B2B business, the revenue math goes ugly really fast. But ugly math and a broken product are two completely different things. My read on Galileo is this. It is a concentration risk event, not a broken business. The product works. The relationships are there. The question going into Q2 is simple. Is Galileo signing new clients and is revenue stabilizing, or is it still declining? That is the number to watch. How quickly they can replace what Chime represented will tell us everything about whether this was a temporary dip or a structural problem. The second concern is macro. Several of the analysts cited tariff uncertainty and consumer credit pressure as reasons to lower their price targets. SoFi's personal loan book does have exposure to consumers under financial pressure, and if charge-offs rise, that is a real headwind. But here is my verdict on the macro cuts. This is a fear premium, not new data. Every analyst who lowered their target cited macro concerns using the same assumptions that were already in their models last quarter. Tariffs did not materially change. The environment actually got slightly better in some areas. What changed was the stock price went down, sentiment got negative, and analysts adjusted their targets to match the fear in the room. That is not analysis. That is reaction, and fear premiums are exactly where long-term investors tend to make their money. Now let's talk about the thing that actually made me want to cover this today. SoFi quietly acquired 2 companies after Q1 earnings. The first is Primary Bid, a British fintech that powers direct share programs which allow companies going public to offer IPO shares directly to their employees, customers and partners digitally and at no cost. SoFi had already been doing a partnership with Primary Bid since October 2024 under their direct share program 2.0. Now they own the whole operation. Think about what that means strategically. SoFi is already working with large enterprise clients through Galileo and their business banking push. Now they can offer those same clients a complete turnkey solution for their IPO, helping companies like Aston Martin and Deliveroo bring their share programs directly to employees and customers through SoFi's platform. It closes another gap in the stack. But the second acquisition is the one that every analyst model on Wall Street is currently valuing at exactly zero. That acquisition is Composer Technologies. Composer is an AI-native, no-code algorithmic investing platform. It handles roughly $200 million in daily trading volume. It allows everyday investors to describe a trading strategy in plain English, have the AI build it, backtest it, and then execute it automatically. No manual tracking, no watching indicators all day. The AI does it. SoFi acquired not just the platform but also Composer Securities, their actual broker-dealer. That means SoFi now owns the full stack from strategy to execution. Here is why this matters. SoFi Invest right now is essentially a basic brokerage, serviceable but not differentiated. With Composer integrated, SoFi Invest becomes something that only hedge funds and institutional players have had access to. Automated, rules-based, back-tested investing at the retail level. SoFi has 14.7 million members. Even if only a fraction of them, say 1 million, adopt algo investing tools through Composer, that is a completely new revenue stream from trading fees, a differentiated product in a crowded market, and a reason for new users to choose SoFi over Robinhood or Public. And Composer's existing users will be coming over to SoFi, where they will be exposed to loans, banking, credit cards, and everything else on the platform. Every single analyst who cut SoFi's price target in the past 2 weeks built their model as if this acquisition does not exist. It is not a minor modeling error. It is a material omission. And when those models eventually get updated to include Composer's contribution, you will see price targets move. To understand SoFi right now, you have to zoom out. Because what management is building is not a bank. It is not a fintech. It is something closer to what people call the AWS of financial services, a full-stack financial operating system that can serve individuals, small businesses, large enterprises, and eventually entire ecosystems. Think about what SoFi can now offer a business. They can help that company set up a card program through Galileo. They can offer employee benefits through SoFi at Work. They can provide big business banking. They can now handle that company's IPO direct share program through Primary Bid. And with Composer, they can offer sophisticated automated investing tools to that company's employees and retail clients. That is a complete wraparound of a business's financial needs in one platform. And that is a very hard thing to replicate. Now add to that the stablecoin initiative. This is the big long-term play. SoFi is building stablecoin infrastructure, and the strategic entry point is Latin America, where inflation and currency instability mean there is massive demand for dollar-pegged digital currency. The Galileo relationships with banks and fintechs in South America give SoFi a way to test and scale that infrastructure before US regulatory clarity arrives through the Genius Act or Clarity Act. Once those stablecoins gain traction, and if the regulatory environment falls into place, SoFi becomes a payment rail. Companies paying suppliers in stablecoins. Retail customers holding balances. Every transaction generating data that SoFi can monetize. And the interest on stablecoin reserves alone, if you model 50 million members with an average stablecoin balance of $2,000, is a number that no analyst has in their model right now because it does not exist yet. I want to be honest here. There is execution risk on all of this. These are long-term bets, and management has had some swing and misses along the way. The enterprise bank software sales push did not materialize the way they initially hoped. Big banks were not going to adopt a new core banking stack until SoFi proved it on themselves first. That is just reality. But the difference between SoFi now and SoFi 2 years ago is that the foundation is much more solid. Capital ratios are strong, around 22 to 23%, which gives them room to absorb expenses from new initiatives without compromising the balance sheet. The member base keeps growing. Fee-based revenue keeps growing quarter over quarter. And management has been laying the groundwork for what they say will be a big 2026 and an even bigger 2027. I have no reason not to believe them. 4 years of consistent earnings growth makes it very hard to dismiss that guidance. Let's talk about Anthony Noto for a moment, because the insider activity here is worth paying attention to. In the past 2 weeks, right in the middle of 10 analyst downgrades and all the negative sentiment, Noto bought shares in the open market. He bought 5,870 shares at roughly $15.73. Then on the very next trading day, he bought another 15,500 shares at $16. Now, some people look at that and say, well, his cash salary is only about $1 million a year, so these are small purchases relative to his total compensation. And that is fair. But in just 2 days, he spent more than half of his annual cash salary buying stock in a company he already has hundreds of millions of dollars worth of exposure to. He did not have to do that. More importantly, and this is the signal I find more compelling, he is not selling. The other insiders are selling, as they typically do after earnings when lockup windows open. But the CEO is doing the opposite. He is buying into the exact analyst downgrades that are pushing the price lower. That tells you something about where he thinks the stock is relative to its value. I would not say small purchases like this are the only thing you should hang a thesis on. They are not. But combined with everything else we've covered, the Composer acquisition, the stablecoin push, the strong capital position, and consistent earnings growth, the fact that the CEO is putting his own money in right now is not nothing. Let me be direct about both sides here, because you need to understand both. The bull case is straightforward. SoFi is a growing financial platform with 14.7 million members and accelerating fee-based revenue. Management has guided for big earnings years in 2026 and 2027. They have made 2 strategic acquisitions that expand their product stack in meaningful ways. Stablecoins and big business banking represent optionality that no analyst is currently pricing in. And the stock has come down significantly from its highs, making the forward valuation much more attractive than it was when everyone was excited at $30 a share. EPS guidance for the full year is 60 cents. If they hit that, and you apply a multiple that reflects their growth rate, even a conservative one, the current price looks cheap. And if 2027 plays out the way management expects, the earnings trajectory could look very different from what analysts are currently modeling. The bear case is also real. Galileo is shrinking and the path to stabilization is not guaranteed. The macro environment puts pressure on their loan book. The multiple is genuinely uncertain. Is this a bank, a fintech, or something in between? And where that lands will define the ceiling on valuation. And volatile stocks can stay volatile for a long time. This is not a steady compounder. It moves hard in both directions, and it will continue to do so. If you're thinking about position sizing here, and this applies to any volatile stock, the question is not just whether you believe in the long-term thesis. The question is whether you can emotionally and financially handle another 30 or 40% drawdown if things get worse before they get better. If you can hold through that and your thesis remains intact, then periods like this are where long-term positions are built. If you cannot, then sizing appropriately matters more than having an opinion on the stock. The valuation at current levels is not the steal it was at $4 or $5, but it is also not the dangerous overvaluation it was at $30. Somewhere in between is a reasonable entry for someone with a multi-year time horizon and genuine conviction in the business. So let me bring it all together. 10 analyst cuts in 2 weeks, a 27% drop in Galileo revenue, macro headwinds on the loan book, a stock that has fallen hard from its highs. That is the bear case in plain English. And it is real. I am not dismissing it. But here is what the bears are missing. Every single one of those analyst models was built without Composer in it, without primary bid in it, without stable coin revenue in it, without big business banking traction in it. The models are backward-looking, the cuts are fear-driven, and the CEO is buying stock into the downgrades. None of that guarantees the stock goes up tomorrow. None of it removes the execution risk on stablecoins or Galileo recovery. Stocks can stay cheap for a long time, and volatile stocks will test your patience in ways that are genuinely uncomfortable. But if you believe, as I do, that what SoFi is building is a genuinely differentiated financial platform with multiple long-term revenue streams that nobody is currently modeling, then the current price looks like an opportunity rather than a warning sign. Watch Galileo in Q2. Watch the stablecoin progress in Latin America. Watch whether management beats and raises or simply maintains. Those data points will tell you whether the thesis is on track or whether something has actually broken. That is where I stand on SoFi today. As always, do your own research, size appropriately, understand what you own, and do not let fear or hype make the decision for you. If you found this breakdown useful, hit the like button. It genuinely helps more people find this content. Subscribe if you want to stay up to date as this story develops, and drop your thoughts in the comments. Are you holding, trimming, or adding here? I read all of them. Until next time, take care of yourselves and we will see you in the next one.